shortly. Okay, we are now live, so I'm going to call the meeting to order. This is Senate Finance, February 11th, and we're going to start today with Abby and tax changes for 2018. There you are.
Yes, good afternoon. Would you like me to jump right into it?
Jump right into it.
Great. So for the record, Abby Shepherd, Office of Legislative Counsel. I'm going to go through the changes primarily that were enacted at the federal level, and then Tax Cuts and Jobs Act, and then Vermont's response that year. So in 2018, actually, the Tax Cuts and Jobs Act was enacted at the very end of 2017. So Vermont responded in its budget bill. It was the one that was finally passed. There was one version that was vetoed. The version that was passed was in the summer. That was Act 11 in the special session. There's also one change I'll go through that occurred the following year, but it was sort of within that movement of response to the federal tax changes. So I will also go back 1 year before that. It all has really the timing is 2018, but the year before, so in Act 73, Vermont changed from the starting, so we're in personal income tax primarily. The starting point for Vermont taxable income prior to 2018 was federal taxable income. Act 73 changed that definition so that the starting point for figuring Vermont taxable income was shifted to federal adjusted gross income. So that again took effect in 2018, although the decision to do that was made in 2017. The Federal Tax Cuts and Jobs Act, again, it was enacted at the end of 2017, and most of the changes were moving forward starting in 2018. Many of the provisions are actually suspensions. I think it has to do with the budgeting process at the federal level. So they're mainly 10-year, the vast majority of the changes were 10-year suspensions. So through the end of December 2025. So the response to those major changes at the federal level in Vermont were pulled through something I'd like to leave, if we can, the discussion of the annual link up to the federal statutes till next week. But the way that the reason that all of these changes at the federal level flowed through to Vermont is that Vermont typically conforms to federal statutes for personal income tax. So I've a whole presentation on that I'll be happy to walk you through and how it applies to last year's federal tax actions. So in the Tax Cuts and Jobs Act, personal exemptions were suspended. So through that 10-year period, Vermont in response enacted its own personal exemptions. They're $4,150 for each individual taxpayer, their spouse, including deceased spouses of filing jointly, and qualifying dependents. Vermonters were also allowed starting in 2018 to deduct a Vermont defined standard deduction, depending on their filing status. So that was in response to the Tax Cuts and Jobs Act change that changed the amount of the standard deductions at the federal level. Again, because the personal exemptions were suspended. Vermont also allowed an additional deduction of $1,000 available to filers 65 years of age or older, and or who are blind, according to the federal credit. So this piggybacks off of what's allowed federally. If an individual is eligible and takes it at the federal level, they get an additional $1,000 deduction in Vermont. So in the Act 11 budget, Vermonters were also allowed to take a 5% non-refundable credit for charitable deductions, as long as those deductions were deductible under IRS rules, under the Internal Revenue Code. So the maximum amount of contributions eligible for the creditor is $20,000. The Vermont marginal rates were also changed. So those were lowered in Act 11. And there are two other fairly significant changes that were made in that act. One was creating the Social Security income exclusion from taxable income, and I could walk you through that if you want more detail on that. It is not available to all taxpayers. It is based on adjusted gross income, so a taxpayer has to be eligible according to their income, and then the amount of federally taxable Social Security benefits are given a phased out exemption depending on the individual's taxpayer's adjusted gross income. The other major change was to the percentage of the earned income tax credit. Prior to 2018, it was a 32% credit, and that was increased to 36% in 2018. The following year, as sort of a response that rolled over into the next year, the legislature enacted the medical deductions. It allowed, so starting January 1st, 2019, taxpayers in Vermont are able to deduct the amount of their itemized deduction for medical expenses taken at the federal level, but that's minus the amounts for the Vermont personal exemption and standard deduction. Additionally, that carved out any amount deducted at the federal level for entrance fees or monthly payments to a continuing care retirement community that exceeds the federal deductibility limits. So I will pause there because I know that's a lot of information. I believe later this week or next week, you will also be getting a primer on income tax structure from Graham.
Okay. The reason we did this, Abby, is because the federal tax cuts, the changes at the federal level, if we did nothing, would have resulted in Vermont collecting $30 million more in tax revenue, income tax revenue. And the feeling was that if we could have used it, but the feeling was if we were going to raise taxes, we should raise Vermont taxes. And so the tax code was adjusted. We collapsed the top two tax brackets. Is that?
It went from 5 to 4.
Yeah. And that had been a recommendation of the original tax structure committee. The charitable credit not allowing a full deduction and the health cost benefit were very controversial. And I don't know that we have ever fully resolved the Wake Robin issue where they prepay for their long-term care. But we tried. Those are the things I remember. Okay. Sandra Hardy.
Thank you. Abby, do you happen to have like a bulleted list of what you just said or something? I tried to write it down and I didn't get very far. It was, yeah. So if
yes, I can
you
circulate
have something you could send to Faith to post, that would be great to be able to look back at it. Thank you.
Absolutely. And I did not, I really focused on personal income tax. There were obviously corporate income tax changes at the federal level, primary ones being removing the rate structure and dropping the highest corporate tax rate to it's 25% or 21%, sorry. I'm blanking on the exact number, but that didn't impact Vermont because we don't follow the federal rates.
We only do at the personal income level?
We do not follow any of the federal tax rates. So we piggyback off of a lot of definitions, but we don't follow federal rates.
Oh, okay. So maybe I misunderstood what you said at the very beginning, which is that we generally conform to the federal tax code. Is that correct? Or okay.
That is correct. And the language there is that Vermont conforms to federal statutes except for the rates.
Except for the rates. Okay. Okay.
And it used to be when I started, it was a flat percentage of your federal tax liability. And was it the estate tax? There was something that got change that was negatively going to impact us. And Stephanie, I know, Barrett said, why don't we, about 10 o'clock at night at the end of the session? And that turned out to be a solution, but we went to the adjusted gross income at the federal level the year before. That had also been recommended by the original tax structure. And as I remember it, that saved us from having a lot of the federal tax cuts passed on to, remember it was saying it was a very good thing we'd done that, or we would have been in a lot more trouble the following year when the tax cuts came through.
Correct, because the decision to switch was in 2017. It was to take effect prospectively in 2018. The Tax Cuts and Jobs Act passed, and then Vermont was already on AGI. So that's the line. And then instead of taking federal taxable income, we started calculating it at a sort of a higher level in the federal calculation. So that did impact what was flowing through and what wasn't.
Okay. So, any other questions? I think it would help if we could get some handouts on this one. I know we had some, because I'm trying to remember, I have a vision of a working sheet we work from. Had all the things laid out on it. It's probably around the computer somewhere. Senator Sirotkin.
So I just want to be clear on one thing, Abby. The chair correctly described what happened with the $30 million. The federal law would have, if passed through, identically would have cost taxpayers $30 million. So we made some adjustments to give that $30 million back. I assume the same theory would apply if the federal government passes tax reductions that reduce taxes on Vermonters, that we would have the ability to take a look at those and not necessarily automatically pass them through. Another way of asking my question, is there something, I mean, maybe it's the thing you said in law that says any change that the federal government makes in calculating taxes other than rates, we automatically accept unless we pass affirmative legislation to the contrary?
So that is the question about the annual link up. So there are different ways that states do this. Some states have what's called a rolling or dynamic conformity, where they automatically pull in federal definitions, federal statute by reference. They incorporate federal code into their tax code. Vermont does it each year. That's the language that's often in the miscellaneous tax bill or the budget, and it's always retroactive. So this year you will get a chance to review it. It is looking at tax year 2020. So the legislature, regardless, I mean, doesn't have to take affirmative action. If you didn't, though, then the link up would stay to federal law in 2019. So you wouldn't pull in 2020 changes. So each year there's a review, there's consideration of, does everything get pulled in? Does some of federal code get pulled in? Which parts? So
So we have,
there is.
so we pass every year, we pass some form of language. Most years we'll say, just do the tie-in. But if we want to, but we have to pass something, right? We have to pass the connecting language each year, right?
If you don't, you don't have to. If you don't, then the link up would be to a prior year's federal code.
So any changes in the federal code, in the current year wouldn't be passed along.
Exactly. And some states have that in their tax codes. They have like a 2005 federal link. So you're getting a sort of a snapshot in time of what was the federal code in 2005.
And is that link up usually done in the miscellaneous tax bill? If we don't have a miscellaneous tax bill, who's offering that language this year?
It's a great question. It typically starts in the House. Often it's in the miscellaneous tax bill. It can be in the budget. In the Tax Cuts and Jobs Act sort of response bill, that was the budget bill. Last year, it was in the miscellaneous tax bill.
It's usually in the miscellaneous tax bill, which isn't titled the miscellaneous tax bill. It starts out as something else. But it's usually one of those it's a housekeeping thing that gets added somewhere. Senator Brock.
Just thinking back to 2018, when we made the change from gross income to adjusted gross income, how did that affect the rates? One, particularly the top marginal rate. And second, did we, after making that change, was that a revenue neutral change, or did something else get snuck in that process?
Several things.
Those are great questions. I'm not really able to speak to the revenue impact, but I just wanted to clarify the prior to 2018 starting point for personal income was federal taxable income. So that included,
correct.
And then it was switched, higher up in that calculation to AGI. The rates were dropped in Vermont to lower the burden on Vermont taxpayers, but I'm really not the right person to be able to answer your revenue questions, but I can pass those on to Graham. I think he'd be the right answer that.
Well,
And the main impacted group negatively with the federal tax changes were middle income families with children, because they lost the individual. You got to double your standard deduction, but you lost the child deduction. So if you had a couple kids, you paid more taxes. And that was what we were looking at. We also added the Social Security deduction. We increased the earned income tax credit, I believe. There were expenditures and there were deductions. We collapsed and lowered the rate at the top end. We did not do the military pensions. That was also proposed. We didn't pass the federal tax, charitable tax, I believe, is above the AGI. So that got passed through. And we were under a lot of pressure to have a Vermont deduction, which we did a limited amount to. And for some reason, no one mentioned the medical cost deduction until the year after, which is why that one got done. No one brought it up and we completely missed it. So for some people, that was a big increase. The other increase, I remember that the feds did, and we had whole charts for who was negatively and who was positively impacted. I think if you owned a business and were in the upper tax brackets, you did very well. If you were working for wages and were in the upper tax bracket and couldn't deduct your state and local taxes, you tended to either not do well or do less well. But that was a one that hit, especially the Northeast states that tend to have high local and state taxes. Senator Sorokin, more will come back to me as we work through this.
So Abby, I don't know if you're the right person to ask, but I'm sure somebody has this. Could we get a list of all the tax changes the feds have put forward in 2020 that we're about to get helped with or saddled with, depending upon what they are? so we can have an idea of whether we want to look at any of those and make sure they don't get passed through or they do get passed through?
We've,
Yes, so that's,
Yeah.
Ram and I will be coming in, I think, next week.
talk
We-
about the link up,
Yes,
which is really it started with the PPP double deduction, but we can talk about in that context, because I was looking at the time and saying, wait, the lick up is just housekeeping. Why are we spending it? But it's more the PPP and the other tax credits that might get passed through. So we can have that presented then. And we probably have some time for, I think Graham has, I think he could spend an entire afternoon, or joint fiscal could, filling us in on different groups and who was impacted and how much revenue we raised and how much we gave up. And I guess I'll get that into this schedule. Whatever we don't do this week, we'll get in there next week. Okay.
yes, absolutely. So I have a very, very detailed long list of all the changes that were made that are tax related changes. And then Graham has a breakdown of what really directly impacts Vermont or will likely impact Vermont. So we have lots of information to share with you
Okay.
on 2020 changes.
Okay. Will Baker is here. Will, have you got anything to add to this discussion?
Hello, Will Baker, legal counsel at the tax department. No, as usual, Abby did a great job summarizing that. I think we did, just a small clarification, in 2017, before the Tax Cuts and Jobs Act, we did make that change, as Abby said, from federal taxable income to AGI. But that was a neutral change. We just moved, if you think of a tax return, we just moved up in the lines from where we started off, and we moved up and subtracted some things rather than being farther down and adding something. So that was a neutral change. And then, of course, when the very end of that year, when the Tax Cuts and Jobs Act came along, that's when we made the substantive changes that Abby described. If you're looking for a list of Vermont tax changes, Abby could borrow from the tax department website highlights. We have legislative highlights for each year, and I'm sure Abby won't feel sheepish for borrowing from that list, because I think she probably wrote them when she was here at the tax department. So it's not stealing, I suppose, if she wrote them in the first place.
It's public information on the website.
Madam Chair, I have a
Yes.
follow-up question. So I'm just trying to, I always struggle with the timing of tax changes and when the money flows. So the changes that the federal government made in calendar year 2020, if we go along with them this legislative session and say we do want a full link up, what budget year does that affect? In other words, the emergency board does revenue forecasts, and so you've done revenue forecasts for the FY22 budget already, and the governor has prepared a budget based on revenue that he anticipates receiving in 2022. How can he do that if we haven't made these changes on the link up yet? So if Abby can sort of walk us through when this link up takes effect and when it affects cash flow into the state and when it affects budgeting for the state.
Yeah, so that gets really straight to the nature of the link up and how it's retroactive. So because it's for tax year or calendar year, however you want to look at it, 2020, those are the returns being filed in this filing season in 2021. So you're looking at an impact as refunds are going out, individuals are paying their taxes. So could potentially start this fiscal year 21 going into fiscal year 22. So my understanding is the assumption with the budgeting is that all of these changes are flowing through, but I would defer to the administration as to how they prepared their assumptions there. But I think also since the tax department is here, I think their form process is based on an assumption as well that as they're preparing forms for this filing season, that everything will flow through. But I defer to Will as to how that works at the department.
So just to put a point, an exclamation point on that. If we decide that some tax change on the federal level shouldn't flow through here, and that would increase our revenues for FY2 and might free up budget, may free up money to spend more perhaps in the budget of FY22. Is that correct?
That's correct.
Okay.
Senator McDonald.
The problem that Senator Sratkin brings up was solved to the administration's credit a couple of years ago when there were tax changes and the administration didn't hesitate and did its best to make Vermont taxpayers come out neutral to they would have been if the tax changes had not been made at the federal level. And I say to their credit because that eliminated a lot of the alternative. And the alternative would have been that the legislature would have had to make those changes. And when the legislature is tasked with making those such changes to keep Vermont from losing money in one case or gaining a lot of money in the other case, when the legislature has to make it, the legislative decision will be, by definition, retroactive. We would be acting on the previous year's, to change the previous year's situation. And that's a problem because if Vermont was going to, if you had to raise extra money to fill a hole, the legislature would be in the position of raising taxes retroactively. And that's a very politically charged job. And if the legislature resulted in Vermont getting more money, well, that was easy because if you cut the taxes to keep at the same level, the legislature would have been credited with lowering taxes, which is a different political, has a different political reaction. So Senator Sarakin's question asks, what happens when the feds change? And if they go up or down, you have completely different challenges to meet. And the challenges are not math challenges, they're political challenges.
And this one, which was strange because the feds went down, but Vermont tax revenue went up significantly. You say to people, because sometimes the relationship between the legislature and the administration when it comes to taxing is not all that smooth. This one, we completely rewrote the Vermont tax code, and it was done in a very cooperative.
Yeah, to the administration's credit.
We didn't agree on everything, but it was done in a very constructive and cooperative manner, and most Vermonters did not realize what went on. But it was a major overhaul of the tax code. But worked, I guess. It was hard to give up $30 million. We were not in a particularly strong economic place, but we did that. So any other questions for Abby or Will at this point? And we'll get some backup documentation for these. And then Abby, you were going to talk to us about tax treatment for remote workers. which we think we have a lot of, but I don't know how we know. I know there's a lot of out-of-state plates floating around here, but I don't know who's staying, who's here for the weekend. What are we doing? And I don't know if the tax department has a program to track, but how would that work?
Right. So really that goes to the way that the tax code operates on voluntary compliance. It is up to the individual taxpayers to know the law and to file and pay. There is information that is on the department's website that I could circulate as well when I send the list of Vermont's changes. Other than, expecting taxpayers to comply, I don't know that there's any particular action being taken. What I wanted to present to you today is the current treatment of non-residents and residents. So non-residents, thinking primarily of those folks who are working remotely for an out-of-state employer and reside in another state. I also wanted to briefly touch on the litigation that's being brought before the US Supreme Court between New Hampshire and Massachusetts on Massachusetts convenience of the employer rule.
Okay.
So under current law, and a lot of questions and suggestions came up when so many individual employees transitioned to remote work in the spring, Vermont law already requires non-residents to pay income tax on their wages, salaries, commissions, or other income received for services performed in the state. So if there's an individual who's working from Vermont, that is considered Vermont taxable income. So that's for non-residents. Residents do pay as well on income earned or received in the state. There is an adjustment allowed based on the amount of that individual's income that's not Vermont income. That adjustment applies to the tax liability, not to their determination of taxable income. Vermont also offers a credit to residents only for taxes that are imposed on their income and paid to another state when the income is, and I just want to read this straight from the statute, where the income is earned or received from sources within that other state. So in the example of a Vermonter who perhaps moved here in April or March and has become, under Vermont's de facto test, has become a Vermont resident, if they are being taxed in another state because in the case of Massachusetts, for example, they have a convenience of the employer rule, then Vermont will offer a credit up to the amount of Vermont tax that they would have owed. And to set out that test for you, the Vermont residents are either individuals who are domiciled in the state or individuals who maintain a permanent abode in Vermont and who are present for more than 183 days. So that means a taxpayer could technically be domiciled in another state because domicile is based on intention, but they could be deemed a Vermont resident because they've been physically present in the state for more than 183 days. The definition of domicile is also set out in statute. It's a place where an individual has a true fixed permanent home and to which place, whenever the person is absent, he or she has the intention of returning. So we'll take a breath there and see if there are any questions about that. And then I'll launch into Massachusetts and New Hampshire, which is an interesting.
Okay, Senator Hardy.
The requirement about having been in Vermont to earn the money is based on the worker themselves, not the job. So if you're a remote worker who is working for some company in New York City, but you're telecommuting in from Middlebury, you're a Vermont resident. If you're here for more than 183 days.
Correct.
Okay.
Yep. So it's interesting that you bring up New York because New York, let me find my list. There are 5 states that have these convenience of employer rules that predate the pandemic. Arkansas, Delaware, Nebraska, New York, and Pennsylvania all have a rule that states, and Massachusetts, did I put them on the list? Sorry. That states that if an individual has an employer in their state, then that is considered taxable income to that state. So New York.
So if I live in Vermont, but I work in Albany, and my employer is in Albany, I earn, that income is taxable to New York State. Okay, I understood. If I work in New Hampshire and New Hampshire does not have an income tax, if the other state doesn't have an income tax, then I'm a resident of Vermont. I owe the tax in Vermont, even though the employer is in New Hampshire. But if I work in New York State, and New York has an income tax, therefore I owe it in New York.
Yes,
This
and then Vermont
is-
offers a credit against Vermont taxes for what you're paying.
Okay, so I have to file in Vermont and say, I earned, $50,000 this year, but here's my slip. I already paid it to New York. Then I get a credit for that $50,000 that I've paid New York.
Correct, and it's non-refundable, so you wouldn't get a refund for that in
Right.
Vermont.
Okay.
And then if there were a difference in the tax rates, if the other state had a lower tax rate, you would still probably owe some Vermont tax.
Oh, okay. So if the other state had a 3% and we had a 4% tax rate, we would owe 1% to the state of Vermont.
Right, so the credit that you're paying in, or sorry, not the credit, the tax that you're paying in the other state, Vermont offers you a credit up to the amount of Vermont income tax liability. So if your income tax liability is higher because Vermont's rate is higher, then you would just get that portion that you paid to the other state as a credit against your Vermont income taxes.
Okay. I should have become an accountant. Okay, Senator Bray.
Are there, I don't know, reciprocity agreements or something like that that work all this stuff out?
I'm aware, and I don't know a lot of detail. I would have to go back and look, but I know around the Washington, D.C. area, there are some reciprocity agreements to avoid it's. So really the issue is to avoid taxing an individual's income twice. So in two different states. But again, there is so much variety that you can end up in the situation like with Massachusetts where, or New York and Connecticut, for example, where an individual could potentially be taxed twice. It hinges on whether the state also offers a credit like Vermont does. And Connecticut's an interesting example because they have a sort of a contingent convenience of the employer rule. So my understanding is it's in reaction to New York's convenience of the employer rule because New York has that rule. Connecticut applies it to New York residents. So it's only triggered if the other state is.
Convenience of the employer says if the employer's in New York, that employer it's going to be more convenient for them. They're filing all the taxes in New York because that's where they are.
Right. And so
they don't care where you live. That's your choice. All right. So states like Vermont say, okay, you earned you live in Vermont. You earned $50,000 last year. You owe Vermont $5,000, but you've already paid $4,500 to New York. So you get a credit and you only owe $500 to Vermont. You're paying the full amount of the Vermont income tax, just some of it goes there. But I can see where you get states like Virginia, where almost everyone in Northern Virginia works in DC, or a large number of very wealthy people in Connecticut work on Wall Street. I think we heard that Connecticut is still hurting from the tax revenue it lost in the recession and hedge fund taxing changes. But so there's another issue. And Senator Brock, you have a question?
Well, it's just a thought that obviously this treatment of income becomes particularly important for us as we engage in our remote worker programs, in which we're bringing people in from other states who are doing work in those states. but they're doing it remotely in Vermont. And I know that there's some litigation that's pending right now, and perhaps Abby, you plan to talk about that as the next step in your presentation.
Yes, whenever you're ready for me to.
But I know a lot of people in Massachusetts live in New Hampshire. I remember when that was called Taxachusetts, and New Hampshire didn't have.
But the issue
and
is, in most cases, in the past, the person may live in New Hampshire, but they physically worked in Massachusetts.
Yes.
They physically work in New Hampshire. Now, I worked for a Massachusetts company for, I don't know, the last 15, 20 years. And the employer was in Massachusetts, and I paid Massachusetts income tax. And then in every single year, I paid more tax to Vermont because Vermont's tax rates are higher than Massachusetts rates. But there it was clear because the job was in Boston, which is where, you know, the office and everything was. It's very different now, though, if you're working remotely and you never have to set foot in Massachusetts. And the question is, does Massachusetts then have a claim on you if all of your work is done and you are physically located in Vermont? That's the question.
okay, Abby, that should give you a segue.
That was a great summary. That's exactly the issue is physical presence and nexus. Does the state have the jurisdiction to be taxing that income? So Massachusetts is one of the states that has had this convenience of the employer rule all along, and prior to the pandemic used a daily allocation rule, which determined the employee's income that was taxable by Massachusetts based on the number of days actually spent in the Commonwealth. So if you're commuting from Vermont into Boston, any partial days that you're in the Commonwealth would be considered taxable by Massachusetts. What changed with the pandemic was a series of temporary rules that were at the end of December made final, so that this rule applies until 90 days after lifting the emergency order in Massachusetts, is that any individual employee that was working in Massachusetts prior to the emergency order will continue to be considered to be earning taxable income in Massachusetts, even if they're working remotely. So they'll continue to be taxed, and it's often referred to as trailing nexus. So now going into tax year 21, so the current year, these individuals have maybe not set foot in Massachusetts at all in 2021, but they're still considered to have taxable income in Massachusetts because they're working for an employer who is located there. So New Hampshire does not have personal income tax, and has brought this case against Massachusetts at the Supreme Court on a couple of different grounds. So I just want to pause to make sure that the Massachusetts current rule is clear. If there are any questions about that.
We got that. We all look like we're in deep contemplation. Senator Sirotkin.
Yeah, I'm having a lot of trouble following all this. I need a chart with like stick figures of who it is, where they work.
Senator McDonald, where's your marker?
Right.
Flow
But
chart.
right. But so the Massachusetts, just so I'm following it, the Massachusetts law premised their taxation on the number of days the out-of-state person was physically present in Massachusetts and working.
Yes.
And now, because of the pandemic, those physical days were either eliminated or cut substantially, and they just want to look back and say, well, you would have been here if it wasn't for the pandemic, and so we're going to just use that as a substitute, and we still want our tax money.
That's correct. That's the gist of it.
Okay.
And on the other side, we're in Vermont saying, oh, we think we'd like your tax money too, since you've been here for almost a year. We've been potentially providing fire, police, ambulance services to you. We're going to be providing medical care to you if you get sick. So we think we would like some of your money. And then there's New Hampshire, but Senator Pearson.
I agree, it is confusing to keep track of the details, but the Vermont premise has always been that we think it's fair you're taxed at X%, and in fact you're paying Y to some other states, so we'll just hit you up for the difference. And that's been very consistent no matter what else is happening in other states, right? Are we considering a change to that, or maybe I missed something? Is that in play, so to speak, Madam Chair?
I think what's in play, I mean, if you're living in Vermont and you're working in New York and you come back here at night, that's, I don't think, in play. What's in play is I have a family member who moved all her kids and her husband out to her, a Vermont cottage they'd bought almost a year ago, and they have been there for a year. They're working remotely. They have been living here for a year. We're saying if you're living in Vermont and working, that's what's different, is they haven't set foot in Massachusetts. And so I think normally the time that they're here and earning money here, they would have paid that percentage of a tax. But that, I think, it's how are those folks who are living here, are domiciled here, have been here for more than the 183 days, but are working, but they still consider their residence somewhere else. How are they going to be taxed?
Well, this is my question. Is the administration proposing a change? Do we have a bill that's proposing a change, or we're just talking this through today?
We're just talking this through because the question has come up.
And along those lines, there would be a homestead implication too, I should think. And I don't know if we need help thinking about that, but suddenly your second home is actually, you can't really pay property tax as a non-residential rate if you're in fact living in the building, right?
I think that's probably a new, normally, if you're here 183 days, then that would be your homestead. But you file your homestead declaration, so that's another question, is that impact? And that would have some revenue impact on the ed fund as to whether or not this is a homestead. Senator Brock.
I'm not sure that from our perspective, at least, it's that complicated. If you're a resident and you're domiciled here, which means you're spending the majority of your time here and that's where you live, then it's a domicile for property tax purposes. And it always has been the same true for income tax purposes. If the work that you're doing is you're doing it in Vermont, as opposed to traveling to Massachusetts or wherever else, it's Massachusetts that's thrown this monkey wrench into the thing by trying to adopt a creative means for continuing to collect taxes on people who don't live there. That is our challenge. And I think there's something like 10 other states that have filed in support of what New Hampshire is doing in the Supreme Court. Vermont is not one of them. And one of the questions I raise is that something that Vermont, and this is a question for the Attorney General, would perhaps want to join in, because it's obviously, if Massachusetts prevailed, it is very detrimental to us, particularly as we move on things like these remote worker programs.
Okay, Senator Hardy.
Thank you. And following up with what Senator Brock just said, and also your example, Senator Cummings, Abby, in Senator Cummings' example of the family that's living in a cottage in Vermont and teleworking to Boston or to Massachusetts, would Vermont then, if they're paying Vermont, or if they have to pay Massachusetts income tax because of this new change, in Massachusetts, would Vermont then give them a credit on the amount that they paid in Massachusetts? Yes.
Yes.
Okay. And so
Yes.
that's where we would lose out on the tax revenue, because we would be giving them a credit for all the days that Massachusetts was claiming they would have been in Massachusetts, but really they were in Vermont, working in Vermont. Okay. I just want to make sure I understood it clearly. Got it. But that's okay. I won't muddy the water. Thank you.
Senator McDonald.
I think it was, oh my goodness, Tom, who's our advisor there? The economic
Oh.
advisor.
Quebec.
Pardon?
Hello.
Yeah, he reported over a half a dozen years ago, the worst thing that could happen to Vermont was that New Hampshire instituted an income tax. Because the number of people who live in Vermont and are employed in New Hampshire would owe their taxes to New Hampshire, and Vermont would get the remains. And that would, something like a hit like 8% of our income tax revenues would dissolve overnight if New Hampshire instituted an income tax of, he gave an amount that was about half our rates. So.
Yeah. And I think most people now see remote work, if not totally the future, at least going to be a lot more common. If I can come up here to my second home and work Friday and Monday, I'm going to be in Vermont a lot longer than I might have otherwise been. And technically, I would owe Vermont income tax on those days. But if the Massachusetts prevails, their proposal, then the states, probably rural states, that people might migrate to for weekends or summer vacations, and still work, we're going to start picking up more of the cost of services for those folks. If we get the big immigration we kind of hope we get or not. So this has implications for the future, not just during the pandemic, but how are remote workers going to be treated, and where's the cutoff line?
So Abby going to find us the answer to that?
Sure. She just tells us what we did.
I would like to point out that the language in the credit statute is not explicit about requiring the individual to be physically present in another state in order to get the credit. So it just says that the credit is allowed against the tax imposed upon the taxpayer's income earned or received from sources within that state, the other state. So it doesn't seem to require physical presence. So that is one potential way of limiting who gets the credit.
Okay. Senator Bray, you have a question?
Well, I just appreciating what you were just saying, because I was thinking we've been talking about remote workers as kind of a golden goose, and they over time they could be less golden than we think if all their earnings are going to be extracted by the states that they're employed in.
Right.
Yeah.
A bronze goose, maybe.
Okay. Will, do you have anything to add at this point?
Yes, thank you. Just a couple comments on the conversation. From my own observations, anecdotal, but I think they're probably factually true. I think that Vermont is a net winner in this pandemic workplace atmosphere, because more people are riding out the pandemic in Vermont than there are Vermonters riding out the pandemic somewhere else while still working for a Vermont company and still saying that they really do live here. Also, that we've talked a lot today about wage earners where they pay tax in this other state, but there's another category of people who are self-employed who relocate even temporarily, and so that these credits paid to other states aren't so forceful for people who are self-employed or who have more passive earnings than sort of someone like me, a typical wage earner. And then just one comment on the New Hampshire and Massachusetts case. I shouldn't speak for the Attorney General's office, although I am an assistant attorney general. But so I'll just, and I'm not, or anyway, I'm not prepared to do that today. But one comment I'll make about that case is that we need to be careful when we talk about how many states have joined on to that New Hampshire case, because there are a few different issues in that case, and some states have joined for different reasons. One issue is this tax issue, and last time I checked, I don't have it in front of me, but I think just maybe two states joined for that reason. I think New Jersey, because they don't love New York's rule either. But several other states have joined for the limited jurisdictional argument about whether the Supreme Court must take a case brought by a state. And that was an issue that we saw in the news recently when the state of Texas filed directly in the Supreme Court to challenge the presidential election. There are many red states who have joined this case for the limited purpose of that jurisdictional issue. I think 10, 11. And that's not a tax issue, totally different issue. So the Attorney General's office can probably find for the committee exactly how many states have joined for this tax sourcing reason, but it's not the total number of states that you see signed on to the
Okay.
petition.
Senator Sirotkin.
Before we leave this, can I just ask some very basic questions?
Mhm.
So I have let's call her a daughter-in-law who lives in Vermont now and works for a California architectural firm. So she gets her salary from the California, but she lives in Vermont. She works remotely. How is her income treated tax-wise?
Abby, you want to, or Will, somebody want to take a shot at that?
I'll take a shot at that. California is not on the list of the states with a convenience of the employer rule. So assuming that she meets the residency test, then she would be treated as a Vermont resident and would be taxed on that income.
Entirely in Vermont, pay no tax to California, right?
I believe that's correct, but I'm absolutely not a California expert. But because they don't have the convenience of the employer rule, I would assume that that's their treatment.
And if they had the convenience of the employer rule, then given the fact that her paycheck is written in California by a California company, her entire income would be paid to California and she paid no Vermont income tax?
So if we I'm going to use the Massachusetts example because they have this very particular, if you were working in Massachusetts at any point pre-pandemic, then we consider this still to be Massachusetts income. It doesn't require physical presence. In that case, then she would be paying Massachusetts, or for California, theoretically, she would be paying on all of her income, and Vermont would give her a credit against Vermont income tax.
And it makes no difference if the architectural work she does is for a client in Vermont, even though the client hired a Massachusetts firm.
Will looks like he might have that answer.
Will has, I think it would, but Will, go ahead.
I don't think it matters where the client is. But even in states that have the convenience of the employer rule, that just means that it's up to the employer to decide where they want you to work. So if this California architecture firm said, yeah, we want to hire you, and your daughter-in-law said, well, I would really prefer to live in Vermont, not California. And they said, well, we're a California company. If you want to live in Vermont, that's fine, but we're going to consider you in California, or that then that California might claim some tax there. But if a Nebraska company just decides to hire someone in Vermont and they don't care where you live, or maybe it's advantageous, maybe you're their Northeast sales representative, then you're a Vermont employee. That your workplace is Vermont. That is Vermont income. That is not Nebraska income. So it doesn't matter where the headquarters of the company is. If that employer wants you in Vermont or doesn't care, then that's Vermont income. And that employer would be responsible for withholding Vermont income, and you would be responsible for paying Vermont income tax as a domiciliary.
Okay. So the flip side of my question is, now take somebody who lives in New York, and please don't throw an exception on what special rules New York has. Let's say it's the Nebraska rules, but they live in New York. They live in Plattsburgh, and they come over and they work at Global Foundries every day. Who gets the income tax?
Vermont would any income that they earn in Vermont would tax them as a non-resident.
What about New York? What you just said in the other example, that they live in this case, they live in New York, they're a New York domiciliary, they pay New York taxes. That's what I thought you just said in the flip example.
Well, someone lives in New York State and drives over every day and works in Vermont, then Vermont would consider them a non-resident, and they would subject them to Vermont income tax. Now, New York, they could claim a credit in New York for taxes paid in Vermont on their New York resident income tax return.
Okay. I got it. Thank you.
Okay, Abby. I think you were, Senator McDonald, did you have a question at this point?
Senator Sratkin's question was answered. But if you flip it the other way, where if you lived in Vermont and went and worked in New York, you would pay a New York income tax. And do I have that right? No.
Yeah. Yes.
And if you were, a few years ago, if you were under $300,000, you'd actually owe Vermont, because you lived in Vermont, what that you earned above what you owed New York. And if you're above $300,000, you would, it would be the other way around. Is that correct? Or is that too complicated a question? Did I fail?
Just not sure what the $300,000.
Yep.
It would depend on the tax rates. I assume if the New York top marginal tax rate was below Vermont's, then you would owe something to Vermont, but you get a credit for, this goes, my son in Canada has to file American taxes, even though he hasn't lived here or earned money here in probably close to 20 years, but he is obligated, every American living abroad is obligated to file American taxes. And I assume it works the same way. He gets a credit for the taxes he's paying in Quebec, which I know are significantly more than he'd pay in Vermont. But that's the way it's done, at least in this country.
My understanding was if you added up your tax obligations in Vermont and compared them to New York and Massachusetts, were you to have earned the same amount of money in New York, or in Massachusetts. If you earned less up to $300,000, you would pay more in New York and Massachusetts.
Okay,
And
you're
if you,
you're
if
getting
you
too
moved-
deep into the
you
weeds,
got up
Senator.
over 300,000, you would pay more in Vermont.
Yes, we have a
Yep.
more progressive tax rate.
Yep.
I think Vermont, Massachusetts has a flat tax, I believe. So, but I would like to get back to the discussion on New Hampshire, because if something happens between New Hampshire and New York, and New Hampshire has no income tax. So what's their argument here? Because they're not gonna lose any money because they don't collect income tax. So what's their problem?
Right, so the case that New Hampshire is bringing against Massachusetts, that again has not been granted cert, so it's not been accepted by the Supreme Court yet. They claim that Massachusetts has infringed on New Hampshire's sovereignty. They claim that there are both Commerce Clause and due process concerns about this overreaching of Massachusetts taxing authority. So they're different, as Will Baker just brought up, a couple of different claims in there over which the Supreme Court could refuse to take that, particularly the fact that New Hampshire doesn't have an income tax, but also the fact that, well, because of that, New Hampshire isn't actually sustaining, or could be ruled to not actually be sustaining an injury because it's not losing revenue. That's one of Massachusetts counterclaims, is that there is no injury and the state is acting on behalf of its taxpayers. It's not acting, so it's not a dispute between states. So that could be one way that the court rules on this, or doesn't rule, but refuses to take it up. So let me pull up my notes. So there are two different claims here, that the Commerce Clause under the U.S. Constitution prohibits Massachusetts from taxing other residents of other states. So I apologize, I have so many documents here. So there are four different prongs to that test. The Commerce Clause allows a state to tax non-residents if it meets these four prongs. So the state's tax must be applied to an activity with substantial nexus with the taxing state. It must be fairly apportioned. It must be non-discriminatory, which means it must not discriminate against interstate commerce. And it must be fairly related to the services provided by the state. And New Hampshire claims that all four of those prongs fail under the taxing regulation that Massachusetts has promulgated. So I could run through those in detail. I don't know how much detail you want me to get into.
Committee, how much? I'm getting some blank looks. The one that's hit me was the relationship to the cost. Because if you're living in Vermont and you're working in Massachusetts, Vermont, if you're living in New Hampshire and you're commuting to Massachusetts, I'm just looking at the traffic, the roadways, the state police, the accidents, and all the services, implied by the volume of traffic going up and down. So Massachusetts, when you're going in there every day, sustains a cost. But if you never set foot in Massachusetts, then a lot of that, there's fewer people your state police have to go pull over, or your parking revenue would definitely go down. But there is a cost to having somebody in your state.
Correct. So that's one of the rationales behind taxing that income, is that the taxpayers are availing themselves of that jurisdiction and its services. So when
New Hampshire is providing that service and they're paying for it somehow in New Hampshire, but not through an income tax.
Correct.
All right. All right, this is getting into tax geekiness. Senator Brock.
I'm going to get geeky a little bit more because I think you can also make that counter argument that if you're working remotely, it doesn't mean that you don't have an office. It doesn't mean that you're operating out of your second bedroom. We have these co-working spaces throughout the state, like the one in Bradford, in which we have people who are out in the boondocks where they live and they don't have broadband internet. And so they go into co-working spaces and they rent space. Even if you're operating in your home, you've got the ability to deduct a home office if that's what you do and you use it for business. And so the remote worker is incurring expenses associated with his or her remote work, everything from telephone expenses to telecommunications to space and so on and so forth. So it's not that all of the expenses are being incurred by an employer somewhere remotely.
So that actually goes more to Massachusetts' argument, saying that they have provided, a highly regulated market for employers. They've provided a employment opportunity, and that's part of their justification for taxing that income.
Okay, yeah, there is the cost of regulating, such as captive insurance. We charge them significantly. Okay, Senator Hardy.
Thank you. So at this point, we're just waiting for the results of this case to see how it may or may not impact Vermont. Is that correct, Abby?
So the litigants haven't pleaded before the court yet. The court hasn't agreed to even hear the case. So
Okay.
right now, the different motions that are and the briefs that are being filed are by New Hampshire, Massachusetts, and then these amici curiae interested parties who are filing in support of, almost all of them are filing in support of New Hampshire.
Okay, so this is just a heads up because it may impact us depending on what the courts do, but we don't necessarily have to act right now to change anything in our tax laws because it may be moot. Am I understanding that correctly? Okay.
Yes, there is still the issue of there are these remote workers, and I just wanted to apprise you of their current tax treatment and that there is a credit in current law. So I don't know if it really makes sense to qualify that as lost revenue because that is the way that current law functions, but just so that you understand how that functions currently.
Right. There'll be probably more of those credits this year because of the pandemic is the speculation.
Yes.
Yeah. Okay.
And this is, I think, also just informative as we go forward with attracting and spending money to attract remote workers of the impact it could have on our income tax, but also the impact if we get into the property tax, it could have on property taxes if they are in fact become homesteads rather than everybody else. So Senator Brock.
Abby, the question is this: in the event that the Supreme Court does not hear the case, what are the implications for us, if any?
So nothing, I don't think there would be anything that would change as to the status quo.
By the status quo, though, does that mean that the Massachusetts employer withholds those taxes and we don't have the benefit of getting them?
That's right.
Now,
So
it
also depends.
Massachusetts and who else?
So as far as I'm aware, Massachusetts is the only of these convenience of the employer states to extend it in this way. So most of these states, my understanding is if you aren't there physically working, at least for 21, so the current tax year, their nexus wouldn't apply. They wouldn't have jurisdiction, wouldn't be considered taxable income in that state. Because
But of course, if
assuming the
does,
person,
they may be encouraged, other states may be encouraged to follow the Massachusetts model if they feel that they're losing revenue.
it's possible.
Okay, folks, we are now up to break time, and I think we could probably all use a break. We're we're coming back and go to the baseload renewable power portfolio requirements. So take a deep breath
Yeah,
and welcome to the varied world of
Right.
finance.
there was if we had time, I was going to ask a question. If we had a shoe salesman who worked in Vermont, New Hampshire, Massachusetts, New York, and lived in Vermont, where would he be taxed? But I'm going to
Oh,
save that
yes,
for when
no.
we come back.
There is
to,
something on TV now, an ad for the TurboTax guy. And if you catch crabs in 2 different states, where do you pay?
Virginia and Maryland, yeah.
That's right, Virginia and Maryland. Okay. We can get to that. All right, thank you, everyone. Faith, are you gonna take us off